Good afternoon and welcome this afternoon to Short Vertical Spreads. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong, who is also an education coach, phenomenal educator. And I'm not going to hold it against her that she's Canadian, but that's okay. We're glad to have her here in the chat. She's there to help facilitate all of the conversation that you have going on there and answer your questions. She's a 20-plus year veteran in the financial markets. She knows her stuff. And I'm glad to have all of you here in the chat as well, whether you're here in the live version or you are in the recorded version. Be a part of the conversation. Chat your questions in. If you're watching in the recorded version, leave a comment in the comment section, and we'll get back to you on that as quickly as possible. So talking about short vertical spreads today, it is an interesting day to be doing that for sure, as perhaps we've got a bit of a conundrum when it comes to volatility, and that's one of the big drivers when it comes to short vertical spreads or short options in general is movement of implied volatility. And today is one of those days where implied volatility has been moving around a little bit. There's been a couple of big earnings announcements that have changed implied volatility on those individual names, but have also changed implied volatility of the market overall. So we're going to take a look at a couple of those as we get into this discussion. We're also going to look at the idea of directionality, and we are going to explore the concept of closing down a short vertical spread positively prior to expiration to avoid taking the possible maximum theoretical loss for the sake of a little bit of gain. We'll talk through that process as we get into this discussion. A couple of quick housekeeping items, however. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or endorsement or advice. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg options, including short vertical spreads, will involve multiple transaction costs. Remember that spread trading must be, in most cases, done in a margin account. Also, remember that when there is a short option, and that short option is an American-style option, which is what most equity options are, there is the possibility that that option could be assigned early prior to expiration, regardless of where it is in the money, at the money, out of the money. We'll talk about that because that will be a core concept in this particular strategy. So keeping that in mind is an important thing. Now, we're going to use technical analysis in this discussion. We're going to use probability analysis. We're going to talk about the option Greeks. But remember, all of those things are theoretical. None of those are guarantees as to the future of what the market is going to do or what prices are going to do. Schwab doesn't recommend use technical analysis as a sole means of investment research. Now, we're going to use the Thinkorswim desktop software platform today, specifically the paper money version of that platform, which is a great sandbox. It's a great learning environment. It is not a guarantee of future success. And remember that the paper money version of the Thinkorswim desktop software platform does not facilitate early assignment of short options. So as you move your practice from paper trading to live trading, be aware that that is only one of the differences, but probably the most significant difference, especially if you're trading short vertical spreads, that it doesn't happen, that early assignment in a paper trading account. It can and does happen potentially in a live trading account. So let's take a look really quickly. And again, I talked through that. I talked through that idea. We're going to maybe perhaps talk about the idea of stop orders in this discussion today. And I just want to preface that discussion by this statement. Stop orders do not guarantee the activation or the fill price of that, you can specify the activation price. You can't guarantee the execution price of that order, or in the event of a stop limit order, the fact that that order will in fact even get filled. So we'll be talking through that as we get into this discussion as well. Before we jump into this, though, really quickly, I wanted to give everybody a quick reminder, and Barb hopefully is going to be back out on the road with us again soon, but we're going to be all over the place in the next couple of months. We're going to be in Washington, D.C. in a couple of weeks. That event is full. The big events that I want to give you some discussion about is this Dallas Market Drive. That's coming up on September 20th at the Gaylord Texan in Dallas. That is going to be a phenomenal one-day event. It's going to be similar to the Chicago Market Drive event on October 4th. It's a one-day top-down discussion event, taking you from insights to action, providing you with some actionable items that you can take away from that. And then on October 10th and 11th, we're going to be in Orlando, and we're going to be doing the technical analysis and options strategies workshop over 2 days. Friday and Saturday, we're going to be there. So join us for any of those events. You can get to that at schwab.com/events. You can register for those events. They are of no cost to you. We feed you. We provide you with lots of information. It is a great opportunity to come and learn and build your skills. So we look forward to seeing you there. I look forward to seeing Barb back out on the road because we have a lot of fun when they were out there. I like teasing Barb a lot. So let's do this. Let's pop over to the Thinkorswim desktop software platform really quickly. And I just want to take a look really quick because I mentioned the fact that the market was moving a little bit and has been moving a little bit today. And it's been moving in mostly an upward direction. And we take a look at the S&P 500 and we see that continuation. We're now breaking out to, once again, new all-time highs in the SPX. So still some bullishness. The RSI, that relative strength index, breaking that diagonal downtrend line. So some momentum behind this move to the upside. So we get that little bit of a move. Take a look at the NASDAQ, and the NASDAQ a little bit stronger, not yet at all-time highs because we've got a ways to go to get back to that. But the RSI also moving higher, a little bit stronger move, breaking out of that resistance line that I drew in there horizontally yesterday in a couple of webcasts. And we take a look at the Russell 2000. The Russell 2000 may be seeing a little bit of profit taking from the strong run that it has made in the small caps and into the mid caps, kind of maybe taking a little bit of profit off of the table as it runs back up into some of these resistance levels back from the October timeframe of last year. Not at all unexpected. Now, what is, I think, kind of interesting here is we bring this into the discussion. I'm going to bring my VIX grid up. And the reason that I bring my VIX grid up, and the reason that I want to talk about two things here. Number one, when we talk about vertical spreads, and especially short vertical spreads, there is an element of directionality to those spreads. Maybe not so much in terms of a directional expectation as when we're maybe looking at a long vertical spread where the bought option, the one that we're purchased, the one that we're long, is the main driver of the trade. That has much more, I think, of a directional, depending on how you structure it, of course, much more of a directional element to it. But a short vertical spread has a directional bias. That's the beginning of the genesis of our assumption and our opinion about what the stock is going to do and about what the vertical spread might do begins with direction. But it also has to include, I think, to a certain extent, an understanding of volatility. And so I wanted to look at VIX here really quickly. And a couple of things going on. Yesterday, we saw a situation where the market was up and the VIX was up. And what that suggested to me, and I had a conversation about this because I taught a webcast yesterday. I don't even, it was my index options webcast, I think, that I was talking. I forgot which webcast it was that I was teaching. Plus, I also talked with Brent Moores on Trader Talks in Today's Market yesterday. Barb was the chat support in that webcast as well. But market up, VIX up is not a usual situation. And oftentimes that can suggest some speculative pressure. So what would have caused speculative upward pressure in the market yesterday kind of as a whole? Well, there were a number of big name top line earnings announcements that were coming out, namely NVIDIA, we saw Snowflake, we saw CrowdStrike, and a few others. General came out with earnings, but it was primarily, and Adolfo, I think you were there yesterday too, we were talking about this, the fact that NVIDIA was coming out with earnings. Now, maybe we overplayed that idea. Maybe we talked a little bit too much about that from the standpoint of it being a market mover. But I would argue that since it made up 7% of the S&P 500 and 14% of the NASDAQ, that it was a significant impact. Now, Chuck, we do have another advanced options virtual workshop coming up. I do not, however, know the time frame on that. However, you can look, if you go to schwab.com/coaching, you can look in the live webcasts and virtual workshops calendar, and it may be there. If that link is going to be anywhere, it's going to be there. I'll show you that here in a little bit. Anyway, so now we have the VIX moving back down again. The VIX is down in the low 14 handle. So volatility is very low. We're running to the tail end now of earnings season. And we're going to be getting into some of those earnings that are kind of those retail earnings and maybe a little bit less of the market movers, but a little bit more of the read on the economy types of earnings announcements. Nevertheless, there are still some earnings announcements out there. So one of the things when we think about a vertical spread, I'm going to use this as kind of a blackboard here in this particular case, is if we're looking at a short vertical spread, let's say, for instance, a short put vertical spread where it has a bullish directional bias, right? So I'm just going to label this blackboard here, short put vertical. And we have a bullish bias. So direction is bullish. Oftentimes when the market moves in an upward direction, volatility falls, right? And so our expectation in a short put vertical spread would be that IV, I'm going to label it IV, would be falling. And we know that the constant is time, and we know that time is always passing. And time is going to be working in our favor in a short vertical spread because it's going to be decaying away. It's going to be eating away at some of that premium that we sold to begin with so that we could buy the vertical spread back at a later date for less than we paid for it to begin with. So that's kind of our directional assessment. Well, when implied volatility is already very, very low, right? When it's already very, very low, kind of across the board, we oftentimes don't see big crushes in implied volatility in periods of time when the market moves higher, simply because of the fact that implied volatility overall is fairly low. So implied volatility is kind of getting compressed. So we need some kind of discrete event to help drive that implied volatility that was theoretically high lower, right? And so that event might be the earnings announcement. Whoops, let's draw that, keep that E in here. That earnings announcement and the passage of that earnings announcement, getting past that earnings announcement, that then drives that implied volatility lower. So short put verticals, short call verticals, an earnings announcement, when the VIX is this low, may not be high yielding trades, may not give us a lot of credit, a lot of premium. And we may not see as much influence from a falling implied volatility in a situation where the VIX is very, very low, because the VIX tends not to compress. I mean, you can see where it's been sitting. I mean, it's been grinding for the course of the last few months down into this 15, 14, grinding down into this range. It's not making big moves to the downside. It's not bleeding off. Now, can it spike higher? Sure. But are we likely to see a big spike to the downside in implied volatility across the board? No, not necessarily. I don't know what type of event would allow for the type of kind of certainty in the market that would decrease implied volatility much below some of these levels. So then we have to kind of be aware of that potential for upside spikes in the VIX and upside spikes in implied volatility on individual stocks, therefore following along from the VIX. So ahead of an earnings announcement maybe presents for the case of selling a short put vertical or selling a short call vertical spread, depending on your directional assumption, Selling a short vertical spread ahead of an earnings announcement maybe presents the best opportunity to take advantage of this implied volatility decreasing. So that's where we're going to kind of focus. And I know that was a long way around to get to this discussion, but it was an important, I think, conversation to have simply in the context of the influences on short vertical spreads. Pay attention to when earnings announcements are. So that's a helpful tip in terms of putting these ideas together. So I've got a couple of examples, and I'm going to start with one that has an earnings announcement over the horizon here a little bit. I'm going to grab my single grid. This is my kind of my playground, if you will, for looking at individual stocks. This is one that is, from a directional standpoint, has been moving higher, is now, however, starting to see a little bit of a downward movement. And in fact, the reason that I came across this one was looking at it, two things. One, it's made a directional breakout to the downside, or breakdown to the downside, below the support level right about the 68 or 68.75 level. Okay, with that breakdown potential there, right? With that possibility and of that continuation ahead of the earnings announcement, there most certainly is a possible influence to the upside in terms of implied volatility. But if we look at what the stock has done on its earnings announcements in the past, and we go back to the last 4 quarters here, actually the last 3 quarters, so we don't know what it's doing here. But we can see that implied volatility rallied into the earnings announcement and then fell. Rallied into the earnings announcement and then fell. Rallied into the earnings announcement and then fell actually a little bit before the earnings announcement. Rallied into the earnings announcement and then fell before the earnings announcement and then crushed. And so we got about 10% almost each time, about a 10% decrease in implied volatility. And so A asks the question, what study or indicator is in this lower panel? It is very simply implied volatility. So I can just go over here to the studies and type in IMP. And if you want to know what that implied volatility does, just click on the question mark and it's going to tell you. This is based on the Black-Scholes or the Berkshire-Stensland, which is a variation of the Black-Scholes model. And it basically simply calculates the expectation of the market in terms of volatility. So implied volatility is forward-looking. Implied volatility says, hey, based on speculative pressures, both to the upside and to the downside directionally, how much are option buyers, primarily, willing to pay extra for those options for the potential for that movement? So think about it as supply and demand. It's a supply and demand gauge. So going into an earnings announcement, there's a lot of demand for options. When there's a lot of demand for options, or gallons of milk or bananas or gallons of gasoline, it doesn't matter. We're ahead of Labor Day weekend. Gasoline prices are going up because demand is higher. And then when that reason for that demand goes away, the price goes down. And when prices are higher, those prices are met by selling pressure. So in that particular case, that's one of the reasons why we talk about this. So implied volatility moving up, and we've seen almost a 10% move in implied volatility in each of these cases. Yes, this is being recorded for sure. A person. Yep, this one's being recorded. So let's put together a short put vertical. Actually, I'm sorry, in this particular case, a short call vertical. Sorry for the cognitive dissonance there. Short call vertical spread, because our initial directional assumption here, the directional assumption is down. Our implied volatility assumption is down after the earnings announcement. All right, we've seen it happen once, twice, 3 times, 4 times on this chart. We've seen it happen. And our time assessment is that time is going to pass. It's going to keep slipping into the future. And so we know that that's going to work in our favor. So those are our directional, volatility, and time-based assumptions or biases or opinions, whatever you want to call them. Yeah, we record all but 2 webcasts a week. The 2 that we don't record are the 2 that focus on exchange traded funds, ETFs. We don't record those for regulatory reasons. All right, so let's pop this into the trade tab and let's take a look at a couple of things. So if our expectation is a move to the downside, we've got a level of support down here, maybe around the 64 mark. And I'm going to draw that line in because that's an important consideration. Number 2, I've got that level of resistance, what is acting as resistance now, at about the 68.75 mark. Was support, now is becoming resistance potentially. So we're going to go to the trade tab. Steve Miller, exactly. All right, so one of the things that we know, looking at Kroger, we know from where that implied volatility was on the chart that we've got some relatively elevated implied volatility. We also know that that earnings announcement is somewhere over the horizon. Now I can look right here and I can say, hey, when's that next? Actually, I can't see it right there. I can go back to the chart and I can see it. It's right here. Here's the next earnings announcement. It's on September 11th. So we can go back to our trade tab and we can say, all right, where's the expiration date that has the highest or the most elevated implied volatility? And it's right there, the September 12th expiration. And that's, if you look at the implied volatility numbers for each one of these expirations, that's the one that has the highest implied volatility. That's the one that has the most elevated implied volatility. Now, here's the thing. If this option expires, these options expire on the 12th of September. The earnings announcement is on the 11th of September. That means that if we're going to take advantage of the big crush in implied volatility, we're likely going to have to hold this trade close to expiration. That becomes a little bit of a threading the needle type of scenario here, because then we're banging up against that possibility, that greater likelihood of the short option being assigned early. So what I'm going to do is I'm going to go out to the next expiration, which still has some elevated implied volatility, but that's going to give me a little bit of buffer, if you will, in terms of when I've got to close this trade down before I start to run into that situation where it's highly likely to be assigned early. Now, the trade-off in this particular case, from going to the 12 September expiration to the 19 September expiration, which is not a big time difference, but the trade-off is going to be in time decay and the amount of premium that we're going to bring in. So we're going to bring in a little bit more premium here for the 19th September, but we're not going to see quite as strong a push in terms of time decay. It's not going to be as big a factor. But the collapse in implied volatility is likely to offset that if we can carry this through the earnings announcement. Now, the risk, though, is that the price of the stock makes a big move against us, which would be in an upward direction in this case, on the earnings announcement. So that's the risk that we take in this particular trade. We're speculating on downward price movement. But if we put the vertical spread in the right place, then even an upward move within reason isn't going to necessarily hurt us that much. So we're going to put this trade on. We're going to look over here on the right-hand side because we're going to be looking at puts. So we're out here at the 19 September expiration. So the other thing that I'm going to do here is I'm going to say the price of the stock's currently at 67, and based on that level of implied volatility, this expected move here is about $4.50, up or down. So if I grab my calculator and I say, all right, where do I think, if this goes against me, how far do I think it's going to go up? We go 67 plus, we'll go 4.5. So 67 plus 4.5 is about 71. Okay. So if this goes against me, we might see that price go up to the 71 strike, 71 half. And I misspoke again, didn't I? because I want this, I'm expecting this to go to the downside, so I'm going to be using calls, not puts. So I might look at selling at that 70 or that 71 strike here. And the reason I'm looking at selling at the 70 or the 71 strike, and let's go back to our charts for just a second. Where's 70, 71? That's up here. It's above that level of support, which was resistance. So we've got that as a buffer in between us and that short strike. And we're still getting a reasonable amount of premium here. Now, here's our delta, about 26 cents delta, which means that the probability of this option being in the money at expiration is about 26%. That's just kind of a thumbnail probability assumption, which means that the probability of this being out of the money is about 74%. That's okay. Now, it's going to lose about 4 cents a day, which is fine. It's going to benefit from a drop in implied volatility of 1% to the tune of 5 cents per each 1%. So if we lose 10% in implied volatility, we're going to lose how much in that option premium? $5 minus, or excuse me, 10% times 0.05. So how much are we going to lose? Maybe about 50 cents in volatility if we get that full 10% drop. Now, David says, isn't the expected move about 50 cents? The market maker move between now and the front month, this expiration, that's a 50-cent move. Okay, that's triggered by this disparity between implied volatilities in the front expiration and the next expiration. That's where you get that market maker move. Okay, but that is not between now and our expiration on the 19th of September, 22 days from now. That expected move is right here, 4.5, $4.05, up or down. That's the expected move. Okay. So we're going to sell that 71 strike, and we're going to buy, if we go out, let's go out to, say, for instance, the 73 strike, and let's see how much we get for a $2 wide. Not getting much for a $2 wide. We're getting 33 cents on a $2 wide vertical spread. So if we were to do that, right, we click on confirm and send, and we see that $33 against $1.67. Let's calculate that out. 0.33 divided by, 0.33 divided by 1.67, about 20%. That's about a 20% return. We could probably do a little bit better if we were to widen that spread out a little bit. Let's go out, say, for instance, to the 74. Now it's $3 wide. Now we're getting 45 cents. But our maximum theoretical risk in the trade increases. But let's see what that looks like. Now we're risking $255 to get $45. So if we were to do the calculation once again, 0.45 divided by 2.55, about 17%. We're reducing that percentage return a little bit. So probably better in this particular case to go to the 73 strike, take it $2 wide, see if we can work that a little bit better here. Now we're recognizing that this is a low return trade. This is a single or a double. If you want to put it into a baseball analogy, this is not a home run. And this is a highly probable low return trade, but not 100% probability that we're going to get that. We could theoretically take that maximum loss in the trade. There is that possibility. So let's go ahead and let's put this trade on, or at least queue this trade up to put this trade on. But I'm going to right click and I'm going to send this to the Analyze tab here really quickly so that we can see what this looks like. So we're going to go out to the 19 September expiration. We're going to look at our highly probable range. That's that gray range there. That's one standard deviation of expected move in the price of the stock. And that stretches. That's a little bit different than that expected move in terms of that implied volatility calculation. So this is saying the expected move from where the price of the stock is now is to about 72.5 and down to just below 62. So where is the majority of our trade? Where is the majority of our trade in this particular case falling? It's in that highly probable area. In fact, our max theoretical loss, which occurs right here, right at the 73 strike, is if the price of the stock is above 73, our max theoretical loss strike isn't even in that probable range. So this is, again, shifting this trade to a high probability type of scenario. Doesn't mean that we can't take a loss. It just simply means that the way the probability is lining up at this point, this is a highly probable trade to be successful. Now, where do we have to be in order for us to break even in this trade? We got to be at 71.32 or below. That's where we break even. So lower gain, higher potential loss, but high probability trade in this particular case. Now, what's the reason Dragon Rider says to choose low return trade stocks? Well, we're kind of forced into, that's a really interesting question. We're kind of forced into that scenario, Dragon Rider. I'm glad you're asking that, because if we go back to this and we say, look, let's grab our VIX grid. The VIX is low. The VIX is in the 14 handle. So there's not a lot of juicy premium out there in the market, even when we're ahead of an earnings announcement, which we are in this particular case with Kroger, right? So we're kind of in that environment where it is a low probability, or it is a low return trade. Now, the trade-off, whoops, I grabbed the wrong grid there. The trade-off to low return in this case is high probability of success. Could we take this as a low probability, high return, long put? Sure, you could. It's going to cost more. You got to be right on more factors, but the return is going to be bigger, but it's the trade-off for the probability in the trade. So our expectation is that the price of the stock continues to move down. And you know what? Even if the price of the stock comes back up a little bit, we can be wrong and still be right in this trade. So let's cue that trade back up again. Here it is. We're going to go ahead and, but you know what? I want to do one thing here. I want to already put in a trade to take this order off when it's done the majority of the work that it can do for me. You've probably heard me say this in workshops before. Buy it back for a nickel and avoid the pickle. So what I'm going to do is I'm going to create this as a first trigger sequential. I'm going to make this order a first trigger sequential. I'm going to right click and I'm going to create an opposite order. And that opposite order is going to be in order to buy back this trade when it's done the majority of the work that it can do for me, which in this case is going to be my metaphorical nickel. So if I can buy back this vertical spread for 5 cents, right? Take the trade off for 5 cents, and I'm going to make that good till canceled. Cool. It's done the majority of the work that it can do for me. And I'm going to go ahead and I'm going to click on send or confirm and send. I'm going to put this in my vertical spreads group, and we're going to fire this order off. And we got it for 32 cents. And we were already queued up an order. Now that order to take this off, if it goes to 5 cents or less, is ready to go. It's waiting. It's waiting to take that trade off. And that's not a stop order. I'm willing to accept the full theoretical maximum loss in this particular trade for the sake of this being a high probability trade. All right, let's take a look at a couple of other examples here. So this is the one that I know that everybody wants to look at, and this is NVIDIA. And I put this trade on a little bit earlier. So I'm going to go to the monitor tab, and we're going to come back to our vertical spreads group. I put this trade on earlier, and you might have in fact have seen this trade earlier on the Schwab Network on Fast Market with Kevin Hinks and Tom White. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. I host a show on there called Your First Trade on the Schwab Network. But I sold this vertical spread. This is NVIDIA, the 170, 167 half put, sold it for 50 cents. It expires on the 19th of September, so going out to that same length of time, even though the earnings announcement has passed. Let's go to the chart here really quickly for NVIDIA. So even though the earnings announcement has passed, and implied volatility has collapsed a little bit. This is one where that implied volatility collapse has wrung the premium out of both sides. So there's not a whole lot I can do. But at the same time, this is a stock that tends not to see big jumps in implied volatility until we get close to another earnings announcement. So we put that trade on NVIDIA. Let's go back to the monitor tab. It's the 170 put, 167 half put. And so unless this stock makes a big move to the downside, because it's now 10 points, my short strike, 10 points out of the money, unless that stock makes a big move to the downside, that's likely to see some decrease in this premium. I can buy this back for less than I was paid for it to begin with at a later date. Now, I want to look at another one because I know I noticed that you were asking questions about stocks that had high implied volatility. Going into an earnings announcement. Laura says, when does that show? So your first trade is rebroadcast. We don't do it live. It's non-linear. So we record it. It is rebroadcast every evening. I want to say 6:30 p.m. Eastern time, but double check that at schwabnetwork.com. Let's go to this one, Lulu, because we're ahead of an earnings announcement here. So Lulu. So remember I said that we're getting a lot of these retail stocks coming into earnings. Notice where implied volatility is. Implied volatility is very near the highest that it has been on this particular stock. And we've got an earnings announcement just over the horizon by a few days, next week, in fact, the 4th of September. So let's go to the trade tab and let's kind of put this together. My expectation here is bearish. I'm looking at this to move, continuing in this bearish downtrend. It's at 200 plus a little bit. We're looking for this to maybe move back down to this support level. But let's go to the trade tab. So bearish directional assessment here for Lulu. And you can see where that implied volatility inflation is, telling me where that earnings announcement is. I'm going to go to the expiration just beyond the 12 September expiration, where implied volatility is still a little bit elevated here. And we're going to look at a put strike. So we're going to look at what that expected move is. It's about $27 to the downside. So as long as I'm selling, sorry, once again, I did that again. I've been in the side of long vertical spreads so long, I have a downward expectation. So I'm going to be using calls in this particular case. Thanks for catching that. All right. So my price right now, the stock is 203. 203 and 27 bucks is the expected move, just rounding that off. So that would say 230 is that upside move. So I'm going to look at selling right around that 230 strike price so that I'm outside of that expected move. So this is where we've got a little bit more premium to go, right? So a little bit more premium in this case, selling that 230 strike, the 26 delta. Theta is working for me. Vega is working for me, selling that a little bit higher premium. And then we're going to buy the 235. We might even go to the 240. Let's see what the 235 looks like. That's going to bring us in 95 cents. That's a little bit too light. So let's do this. Let's sell the 230 and let's buy the 240. Let's make it 10 wide. Now we're getting $1.70 for a 10 wide vertical spread. And we click on confirm and send. $1.70 against 830. Still highly probable. Now let's see what our percentage return is here. Whoops, I got to do this. I got to edit. And then we'll come over here to the left-hand side and we'll go $1.70. Whoops. $1.70 divided by 830 is about 20% return on risk. Not bad, given the fact that the VIX is sitting in the 14 handle. If the VIX were higher, it would be likely that we'd be looking for more like 30% return on risk in this particular case. But once again, high probability, low return. In this particular circumstance, we're going to look at trying to take this trade off once again when it's done the majority of the work. So in this case, I'm going to make that first trigger sequential. I'm going to right-click, create opposite order. And I'm going to look at buying this vertical spread back. If I can buy this one back for 20 cents or less. My metaphorical nickel is a little bit larger here. Before I do this, I'm going to right click and we're going to send this to the Analyze tab. And we're going to take a look at this Lulu trade. And let me float this back real quick. Bring that back. And again, you see there's our highly probable range. The majority of our trade is falling in that high probability range of where the stock is likely to be. So let's pop back over here to our order. And let's click on confirm and send. And we're going to put this in our verticals group. And we're going to fire that order off. Now, the expectation being here once again, and we may have to bump that and work it a little bit, but the expectation is the price of the stock moves to the downside. We're going to sell that call spread up here. We're selling the call spread kind of right above this previous resistance level where the stock is not likely to go. So, a couple of different ways to look at implied volatility, expected move, where the stock is not likely to be, to put together highly probable trades and manage the risk of the trade in terms of taking the trade off prior to expiration before it's done the majority of the work, or when it's done the majority of the work that it can do, so that we don't get down into those last few days. And we did that through two ways. We did that through the selection of our strike price, and we did it. So we looked at Kroger, and the reason we chose this expiration is because it was a little bit beyond the earnings announcement. The reason that we chose the Lulu trade, the length of time that we did, was because it was a little bit beyond the earnings announcement when that expected volatility crush was likely to come in and help us in that particular case. The trade-off for going a little bit longer is the long leg is going to be a little bit more expensive. Time is going to work a little bit less rapidly, but it gives us a little bit of a buffer before we run up into expiration. We're not trying to thread the needle. So quickly, if you want to learn more about these ideas, pop right over here to the Trader Talks webcast page and type in short verticals. And you're going to find a bunch of information about short vertical spreads, including Barb Armstrong teaching short put verticals and short call verticals, a bunch of great webcasts along there. And look forward to seeing you all at some of those events. Join us at schwab.com/coaching, and that's where you're going to find all of the information about our upcoming webcasts, as well as our live events. My thanks to Barb Armstrong for helping out today. My thanks to all of you. Click on the subscribe button if you haven't done so already, and follow us on X. We'd love to have you over there. Have a great day, everybody. We'll see you soon. Bye-bye.